The silver market just sent a signal that almost nobody expected to see this fast. And if you blinked, you might have missed what could be one of the most important shifts in precious metals this year. Silver miners jumped over 8% in a single session. Options activity exploded. And suddenly one phrase is circulating everywhere again. Gamma squeeze. This is not the meme stock chaos of the past, and it's not random price noise. What we're seeing is the result of pressure building quietly for months, then releasing all at once as positioning, sentiment, and structural market mechanics collided. To understand why this move matters, you have to look beneath the surface of price charts and focus on how leverage, options, and supply stress interact in a market as thin and sensitive as silver. Silver has always behaved differently from gold. Gold is held, silver is consumed. Gold is monetary insurance. Silver is both money and industrial fuel. That dual role creates tension during periods of economic uncertainty, because investors want safety while industries still need raw material. Over the last year, that tension has grown more intense. Solar demand continues to rise. Electric vehicle infrastructure keeps expanding, and electronics manufacturers are competing for supply that simply isn't growing fast enough. At the same time, mining investment has lagged, exploration budgets have been cut, and new large-scale silver discoveries are becoming rarer. That imbalance didn't disappear when prices went sideways. It was building pressure. While most retail traders were distracted by broader equity markets, something very different was happening in the options market tied to silver miners. Call option volume began rising steadily, especially on out-of-the-money strikes. This is important because options don't just reflect sentiment, they create mechanical consequences. When traders buy call options, market makers often hedge their exposure by purchasing the underlying shares. As price moves closer to the strike, the need to hedge accelerates. That feedback loop is what creates a gamma squeeze. It's not emotional buying. It's forced buying driven by risk management models. Silver miners are particularly sensitive to this effect because many of them have relatively low float and high volatility. When demand for upside exposure increases quickly, the hedging requirement can overwhelm normal trading volume. That's exactly what we saw when miners surged more than 8% in a single session. The move wasn't led by spot silver alone. It was led by leverage interacting with thin liquidity. That's why the move was fast, sharp, and broad across the sector. What makes this moment different from past silver spikes is the backdrop. In previous cycles, silver often ran on inflation fear alone. This time we have structural supply constraints, geopolitical uncertainty, and a growing recognition that silver inventories are not infinite. Vault data has been quietly trending lower. Industrial offtake hasn't slowed. Recycling hasn't filled the gap. That means price sensitivity is increasing, not decreasing. When price finally responds, it tends to overshoot. The miners reflect that leverage even more dramatically. Mining stocks are not just tied to the price of silver, but to margins. A small move in silver can translate into a massive move in cash flow expectations. When silver rises while energy costs stabilize or decline, profitability can expand very quickly. Markets price that in fast, especially when positioning is light. Many institutional portfolios were underweight miners coming into this move. That created another layer of demand once momentum shifted. There's also a psychological component at play. Silver has spent years frustrating both bulls and bears. Every rally faded, every breakout failed, and confidence slowly drained away. That kind of environment breeds complacency. When the move finally comes, positioning is wrong. Traders are caught leaning the wrong way, volatility spikes, and the market moves further than logic says it should in the short term. That's how squeezes work. They don't ask for permission. It's important to separate what is happening now from unrealistic expectations. A gamma squeeze does not guarantee a straight line higher forever. These moves can cool off just as quickly as they ignite, but they often leave lasting effects. Volatility regimes change, options pricing adjusts. Investors start paying attention again. Capital flows that had been dormant begin to rotate back into the sector. That's where longer-term implications emerge. Silver miners outperforming the metal itself is a key signal. It suggests that investors are not just chasing a short-term trade, but beginning to reprice future earnings. When miners lead, it often indicates confidence that higher silver prices can persist long enough to matter fundamentally. That doesn't mean prices can't pull back. It means the conversation changes. Instead of asking whether silver can break out, markets start debating how high margins can go if it does. Another factor fueling this move is the broader macro environment. Real yields remain volatile. Debt levels continue to climb globally. Confidence in fiat systems isn't collapsing, but it's being questioned more openly. In that kind of environment, precious metals regain relevance, especially those tied to industrial growth. Silver sits at that intersection. It benefits from economic expansion and hedges against instability. Few assets can do both. What we are not seeing is panic buying from the public. Search interest remains moderate. Social media excitement is rising, but not euphoric. That's important because true market tops usually require mass participation. Right now, this looks more like the early stages of re-engagement rather than the final blow-off. The options market lit the fuse, but the fundamentals are providing the fuel. Risk still exists. Miners face political challenges, operational risks, and jurisdictional uncertainty. Energy prices can rise again. Governments can change tax structures, and silver itself remains volatile. Anyone watching this space should understand that sharp moves cut both ways. This is not a guaranteed path. It's a high-energy environment where discipline matters more than excitement. The biggest mistake people make during squeezes is chasing late without a plan. By the time a move feels obvious, much of the mechanical buying has already occurred. That doesn't mean opportunity disappears, but it changes shape. Instead of explosive upside, the market may shift into consolidation, rotation, or selective leadership. Strong miners with solid balance sheets often separate from speculative names once the initial surge fades. Another overlooked detail is how gamma squeezes affect future price action. When options expire, hedges unwind. That can cause temporary pressure in the opposite direction. But if new call demand replaces old, the structure stays tight. Watching open interest and expiration cycles becomes more important than watching headlines. The real story is in positioning, not predictions. Silver has a history of surprising both believers and skeptics. It moves slowly until it doesn't. When it finally responds to underlying pressure, it rarely does so politely. The current move in miners may be the market's way of signaling that the status quo is no longer sustainable. Supply constraints, rising demand, and financial leverage don't resolve quietly. They resolve through volatility. This doesn't mean silver is heading to a specific price, or that miners will only go up. Markets don't work that way. What it does mean is that the narrative has shifted. Silver is no longer being ignored. The miners are no longer dead money. And the options market is no longer complacent. That combination deserves attention, not hype. If history is any guide, periods like this tend to create opportunity for those who stay patient and informed. The easy money from the initial squeeze may already be gone, but the structural forces remain. Whether this becomes a sustained trend or another violent but temporary move will depend on how demand, supply, and macro conditions evolve from here. For now, the signal is clear. Something changed. Silver miners didn't move 8% by accident. Gamma squeezes don't appear without pressure, and markets don't reprice sectors unless expectations shift. Whether you're bullish, bearish, or neutral, ignoring that message would be a mistake. The next phase won't be decided by emotion. It will be decided by data, positioning, and follow-through. That's where the real story will unfold, and that's where the smart money will be watching closely. If you found this breakdown useful, make sure to stay locked in, because silver doesn't give many warnings before it moves again. And when it does, it rarely whispers.